So good evening and welcome to the class today. In our today's session, we want to focus on IFRS 16, International Financial Reporting Standard 16. Now, International Financial Reporting Standard 16 deals with leases. It covers leases. So what is a lease? A lease is a contract or part of a contract that conveys the right to use an asset for a period of time in exchange for a certain consideration. So a lease is basically a contract between two parties that conveys the right to use an asset for a certain period of time. You don't use it forever. It's for a limited period of time in exchange for a certain consideration. So a contract must always be an agreement between two parties. Now, in leases, the contract is between two parties. One party is called a leasee and another party is called a lessor. So a lease is a contract between two parties. One party is called a leasee and the other party is called a lessor. Leasee, L-E-S-S-E. And lessor, L-E-S-S-O-R. So it's a contract between a leasee and a lessor that conveys the right to use an asset for a certain period of time in exchange for consideration. Consideration is the money that you'll pay, the amount that you will pay for the lease. Now, in this chapter on leases, or in this standard on leases, we are going to look at which are the few terms we are going to define in leases. We'll be defining what is a leasee, what is a lessor, what is a right to use an asset, what is a lease liability, etc. Remember, we have already defined what a lease is. A lease is a contract between two parties, the leasee and the lessor, that conveys the right to use an asset for a certain period of time in exchange for a given consideration. So we will be defining terms and then we'll be looking at recognition. Recognition is to incorporate an item to the financial statements. How do we post leases into the financial statement? What amount do we take to the statement of financial position and under which section in the statement of financial position? What amount do we take to the income statement and under what section? Is it under incomes or is it under expenses? Now, when we look at recognition and measurement, we have been looking at previous standards and we said there is what is called initial recognition, and then there is also what is called subsequent recognition, or initial measurement and subsequent measurement. So that is what we are going to focus on. So let's start by defining some terms. Now, in our definition of terms, our first terminology is leasee. Now, who is a leasee? Leasee is the entity that obtains the right to use an underlying asset. In normal sale agreement, leasee is like the buyer, the entity that obtains the right to use an underlying asset, and he must be in a position to pay something in exchange for a certain consideration. It's like the buyer in this context, in a context of a sale. Lessor, which is the second definition, lessor is the entity that provides the right to use an asset in exchange for consideration. It's like the seller. The lessor is like the seller. The leasee is the person receiving the asset. The lessor is the party giving out the asset. What is right to use an asset? Represents the leasee's rights to use an underlying asset for a lease term. So the right to use an asset. The right to use an asset for a certain period of time. Now, when there are two major items, we should know how to calculate under lease agreements. There are two major items. We must know how to account for them in a lease standard. Number one, you must know how to recognize right to use an asset. This right to use an asset is the cost. For example, when my business leases a motor vehicle, when I lease it for maybe a period of 5 years, I have a right to use the motor vehicle for a period of 5 years. In that case, that is what, when I receive the asset from the lessor, I have the right to use the asset for a period of time. In that case, that is what is called right to use of an asset, which is normally a non-current asset, and it is recognized at cost. Lease liability is recognized at present value. Lease liability is recognized at present value. Now, let's start with right to use an asset. Right to use an asset. And we have said under initial recognition, the right to use an asset is recognized at cost. In other words, the cost which goes to the non-current assets in the balance sheet, what do we call it? Right to use an asset. So instead of putting there maybe non-current asset and saying land and building, what will you call it? Right to use an asset. So how do we calculate the cost of an asset in short under lease agreement, or what we call right to use an asset, because the right is recognized at cost? So to calculate the cost, please let's be attentive here. This slide is very important. Number one, you must calculate lease liability. You must identify what is the lease liability. Now, how do we calculate lease liability if it is not given? Lease liability, if it is not provided, it is the present value of payments made over the lease term. Now, there is what we always call rentals. Now, when we lease a property for 5 years, it means maybe we'll be paying rent for 5 years. So there is the rent of year 1, rent of year 2, rent of year 3, rent of year 4, and rent of the 5th year. Now, these are payments that we'll be making over a period of 5 years. Now, these payments, because they'll be made in future, we must learn how to discount them. We must learn how to calculate their present value. Now, the present value of these future cash outflows, the rentals to be paid, is what is called lease liability. So what is lease liability? It is the discounted, it is the present value of future cash outflows, the future rentals that we will pay. The second component of cost is initial direct costs. You know, when you are leasing a property, there are some agreements, there are some contracts that you will sign, and maybe there are some initial costs that you will incur in the process of trying to sign the contract. Maybe there is a leasing agreement cost to be signed, and you as the lessee, you are the one bearing the costs of the leasing agreement costs. Maybe there is a lawyer to be brought to witness what is taking place. You are the one to meet these costs. They are known as initial direct costs. Number 3, cost of removal and site restoration. Just like in I-16, remember the cost of an asset included the purchase price, directly attributable cost of bringing an asset to its present location and condition, dismantling, restoration, and removing costs. So that is the point, same as here under IFRS 16. Point number 3, cost of removal and site restoration. Point number 4, payments made at a prior, or prior to commencement. Any payment you make on the day you signed the lease agreement, any payment you make on the day you signed the lease agreement, in that case, it still falls as part of the cost. And sometimes the lessor gives you an incentive to encourage you to lease the property. Maybe he gives you some discount to encourage you to lease the property. There is somebody interfering with the screen, please. So any incentive you are given, it reduces the cost of the asset. Any incentive you are given, it reduces the cost of an asset. For example, maybe you are to lease some space in some mall, in some shopping mall, and maybe you are a big brand, and the owner of the shopping mall wants you to lease that property to enable you to enable the owner attract more rent in future. So, you know, if big brands rent the premise, the shopping mall will sell. So in order to attract you as a big brand, they may give you an incentive that we will give you an incentive worth maybe 10 million, that we will give you a discount maybe worth 10 million, or you will not pay rent worth 10 million. In that case, that is called a lease incentive. This lease incentive, it's deducted when we are trying to calculate the cost of an asset. The cost of an asset, in this case, the value of the asset is known as right to use an asset. So when you want to calculate the right to use an asset, the cost to be incurred in right to use an asset, number one, the first component is lease liability. Number two, the second component is initial direct costs. Number three, the third component is cost of removal and site restoration. Number four, payments made at or prior to commencement. And number five, if there is any incentives you receive, you less those incentives. Lease liability. Lease liability is simply the present value of lease payments. The present value of lease payments that you make per year. So if you are paying rent every year, you are paying rent of 1 million every year, 1 million in year 1, 1 million in year 2, 1 million in year 3. When you calculate the present value of these 1 million in year 1, 1 million in year 2, and 1 million in year 3, this calculated present value, when you get this total present value, that is what gives you the lease liability. That is what gives you the lease liability. The lease liability. Now we have an example. And this example, we want to know what is our objective in the example. We want to know how to calculate the cost of an asset under the right to use. How do we calculate, number one, right to use an asset? And number two, how do we calculate the lease liability? So let's follow this example before we go to Excel. So we are being told on 1st January 20X1, Dynamic entered into a 2-year lease for a lorry. So they got into a lease agreement for a lorry for a period of 2 years. The contract contains an option to extend the lease term for a further year. So they got into a contract of 2 years, but the contract stipulates that there is an option to extend the lease by a further 1 year. So that will make it 3 years, subject to certain conditions, of course. Dynamic believes that it is reasonably certain to exercise this option. What is it reasonably certain to exercise? The option to lease for the 3rd year. Lorries have a useful life of 10 years. But remember, we are leasing for a total of 3 years. There is the 1st year, and there is the option to extend by an additional 1 year. So lease payments are 10,000 per year for the initial term, and 15,000, what are the initial term? Year 1 and year 2. And 15,000 per year for the option period. What is the option period? Year 3. All payments are due at the end of the year. To obtain the lease, Dynamic incurs an initial direct costs of 3,000. The lease interest rate within the lease is not readily determinable, and dynamic incremental rate of borrowing is 5%. Required, calculate the initial carrying amount. In other words, recognize the asset for the first time. How much do we recognize? Calculate the initial carrying amount under initial recognition and the lease liability, and of the lease liability, and the right to use the asset. So you are being asked, under initial recognition, calculate the carrying amount of number one, lease liability, and number two, right of use of the asset, and provide the double entries needed to record these amounts and provide the double entries needed to record this amount. Now, let's go to Excel. Let's go to Excel to enable us solve the question. Okay, so that is the same question. So let me read it once more before I start solving it. On 1st January 20X1, Dynamic entered into a 2-year lease agreement, for a lorry. The contract contains an option to extend the lease term for a further year. Dynamic believes that it is reasonably certain to exercise this option. Lorries have a useful life of 10 years. Lease payments are 10,000 per year for the initial term and 15,000 per year for the option period. All payments are due at the end of the year. To obtain the lease, Dynamic incurs initial direct costs of 3,000. Interest rate within the lease is not readily determinable, and Dynamite incremental rate of borrowing is 5,000. Calculate the initial carrying amount of the lease liability and the right to use the asset. So we are looking at the solution to that question. I'm just slightly extending the size. Okay, so in this, the lease term, so in our solution, we are being told to calculate the right to use an asset and the lease liability. The lease term is 3 years. 3 years. That is our opening statement. The lease term is 3 years. This is because the option to extend the lease is reasonably certain to be exercised. If it was not certain, we could have only recognized, how do you write exercised? Exercised. If it was not certain, we could have only recognized 2 years. But you are being told Dynamic believes that it is reasonably certain to exercise this option. Now, once we have done that, we need to calculate, number one, lease liability. Let me bring it down. Number one, we need to know how to calculate lease liability. Maybe in the chart, how do we calculate lease liability? Can you type for me in the chat? What did I say under lease liability? How do you find the lease liability? Lease liability is lease liability. Okay, I'm not seeing response. Lease liability is the present. Okay, I'm seeing people responding now. Thank you. Is the present value. Lease liability is the present value, that means we have understood it, of the lease payments. The present value of the lease payments. Now, in managerial finance or financial management, we know how to calculate present value. You will show the date or the period. You will show the date or the period. You will show the cash flows. I want to calculate the present values. You'll show the cash flows. You'll show the cash flows. You'll show the PVIF. Let me just call it discounting factor. Or let me call it PVIF. PVIF, present value interest factor. In other words, the discounting rate. And then you will show the present value. Present value. So those are the what you'll need to show. Okay. Now the first year, remember the lease contract started on 1st January 20X1. So which means that year ends, that year certainly ends on 31st December 20X1. A year that starts on 1st January 20X1 ends on that. Remember, it was for 3 years. The second year will end on 31st December 20X2. The third year will end on 31st December 20X3. So we have those. And what are the cash flows? Lease payments. Remember, it was present value of lease payments. The lease payments were 10,000 per year for initial term. The initial term was 10,000, was 2 years and 10,000. And in the third year, the option year, the lease payment was 15,000. 15,000. Okay. Now, present value interest factor. You are told the borrowing rate is 5%. So that is a discounting rate. So in this case, we'll have it as 5%. 5%. And here we are applying managerial finance, 5%. Now, how do we always calculate the present value interest factor? It is normally, let me maybe write it here, 1 divided by, into bracket, 1 plus R raised to power N. Raised to power N. I can use this raised to power N. So that is what I want to apply here. Now, at the end of the first year, the formula will be 1 will be equals to 1 divided by, into bracket, 1 plus 5% is the same as 0.05. 5% is R is 5%. 5% is the same as, if we put it over 100, it's the same as 0.05. Close the bracket, raised to power year 1. So what do we get? We get maybe to 3 decimal places. So the PVIF, the discounting factor, is 0.952. In year 2, we repeat the same. 1 divided by, into bracket, 1 plus 0.05 raised to power 2. So that gives you 0.907. The discounting rate in year 3 is 1 divided by 1 plus 0.05, close the bracket, raised to power 3. So that gives you 0.864. So what do we get here? The present value. It is the cash flow times that. It gives you 9 in year 1, the present value of 10,000 to be paid in year 1. The current present value is 9,524. So now, what is the total present value? So the total present value is 31, and this becomes the lease liability. This becomes the lease liability. Please, I'm repeating. Lease liability is the present value, of the lease payments. Lease liability is the present value of lease payments, the present value of lease payments. So we have answered requirement number 1. Let's come to requirement number 2. Requirement lab 2 was asking us and the right of use of asset. Right of use of asset. Right of use of asset. How do we calculate right of use of asset? How do we get this right of use of asset? We have already looked at lease liability. Now remember we said right of use of an asset includes, if you remember what we said, right of use includes, what did we say? A, number 1, lease liability. Number B, we said direct costs. Number 3, we said removing and restoration costs. Number 4, or D, we said it includes what else? We said it also includes removing. Number 4, it includes removing and restoration. Number 4 was, okay, number 4, you less any lease incentives. Lease incentives. So basically, that is what we said that lease includes. So what is there we account for? For example, lease liability, we already know. The lease liability, we have already calculated it. It is 31,552. Do we have any direct costs? Okay, what I was struggling in, I've remembered it. Number 4, any advance payment made. Advance on commencement. I will explain what that is with an example. And E, less lease incentives. So in order to calculate the right to use an asset, in order to calculate lease liability, you just calculate the present value. Now, right to use lease liability, we have already got it as 31,552. So let's look for direct costs. Lease payment was that. Now let's continue. To obtain the lease, Dynamic incurs initial direct costs of 3,000. So direct costs are 3,000. Next, the interest rate within the lease is not readily determinable. So there is no removing costs, it is 0. There is no advance, and there is no lease incentives. So what is the total? That plus 3,000 plus 0 plus 0 minus 0. So that gives you the right to use an asset. So the right to use an asset, in this case, it is 34,552. So that is right of use of asset, right? In other words, this is the equivalent of cost of the asset. Right of use of asset. This is equivalent to the cost of the asset. And then now this is what you'll be depreciating. So that is right of use of asset. So that is how we calculate right of use of asset. Remember, you must know how to calculate the right of use, which is the equivalent of cost of the asset. So this will be the cost of the asset. And you'll have to also know how to calculate the liability component. You'll have to know how to calculate the liability component. Now, sir, how do we allocate cash flow? How do we allocate cash flows? It was given in the question. So lease payments are 10,000 per year for the initial term. Remember, you were told Dynamic entered into a 2-year lease agreement. So initial term is 2 years. So 10,000 for year 1, 10,000 for year 2. The contract contains an option to extend the lease for a further year. This is the further year, and the amount is 15,000. I hope I've answered the person who asked that question. I hope you are answered so that we move on. Now, what is the double entry? You are also asked for the double entry. What is our double entry? So in our double entry, you will have debit. You will debit right of use, because this is an asset. Right of use, the cost of the asset rather. Right of use of asset. You will credit lease liability, and you will also credit cash that was spent on initial costs. Cash that was spent on initial cost. So right of asset is 34. And then you credit lease liability is that. And then the cash that was spent on direct costs is 3,000. I believe it will balance. If you add this, it is 34. So that's how we account for double entry. So I'm repeating, what is our objective? And this is normally a common question in exams. What is our objective? To know how to calculate lease liability. And number 2, to know how to calculate right to use an asset. Right of use of an asset. Remember, we are in initial recognition. Remember, this is at initial recognition. At initial recognition. At initial recognition. So at initial recognition, that is what we do. But you know, as accountants who have done IAS 16, apart from initial recognition, there is also what we call subsequent recognition. Subsequent recognition. But that is for another time. So let's go back to the slides. So let's go back to the slides. So we have seen how to account for that. And we have another example. So let's follow this example and remember that format we have learned. ABC Limited prepares financial statements to 31st December each year. On 1st January 2018, ABC Limited began to lease a property on a 10-year lease. The annual lease payments were 2.5 million payable in advance, the first payment being made on 1st January 2018. So the first advance payment was on the date of commencement. ABC incurred initial direct costs of 500,000 in arranging this lease and received a lease incentive of 250,000. The annual rate of interest implicit was 10%. So required, calculate the lease liability and right to use the asset under initial recognition on the 1st January 2018. So it's the same question. Now, in the same question, the context is different. So I'll come here and I go back to what we have done to save time. You remember lease liability. Let me just copy that so that I save more than enough time. So paste that there. I'm just trying to increase the size. Of course, I'll change the dates. Here now, I want to see what Ken taught you. If you understood the discounting according to Ken. Those who are doing managerial finance, you know who Ken is. So if we fail here, I'll give him feedback that these guys never understood. Okay, so we have our question there. So let me remove these ones. Now, according to what you are taught, okay, the lease period is on 1st January. So ABC Limited prepares financial statements to 31st December each year. On 1st January 2018, ABC Limited began to lease a property on a 10-year lease. Annual lease payments were 2.5 million payable in advance. The first payment being made on 1st January 2018. So the interest rate is 10%. And this is an annuity. Why is it an annuity? We were making payments of 2.5 million. Remember, this was not an annuity. Example 1 was not an annuity because in the 3rd year, the amount was different. But in example 2, it's an annuity. What is an annuity? An annuity is a constant sum of money. Constant sum of money received for a certain period of time. Constant sum of money received for a certain period of time, or paid for a certain period of time. Now, let's understand that because it's an annuity, what I'll do, I'll just write year 1 to year 9. I will explain why I picked year 9 and not year 10. So I'll just write year 1 to year 9. Now, according to what you are taught in managerial finance, let me try to summarize it. When we are calculating the present value under the topic discounted cash flows, it is normally assumed that the first payment or the first receipt is 1 year from now. I'm repeating. Whenever we are calculating the present value, it is normally assumed that the first receipt or the first payment is 1 year from today. So if payments were for 10 years, it is assumed that the first payment will be after 12 months. And that is when you will write here 1 to 10. I'm repeating this because it will also help you in managerial finance. When you want to calculate the present value of an annuity, if the period was 10 years, it is assumed the first receipt or payment is after 1 year. So if it is 10 years, you will write 1 to 10 if the first payment is after 1 year. But in this question, the first payment is not after 1 year. The first payment is now. Now is year 0. Now is not year 1. Why? Where have I picked that? What this sentence? Look at this sentence. Annual lease payments are 2.5 million payable in advance. The first payment being made on 1st January 2018. Remember, 1st January 2018 is now, the date the lease started. So the first payment was not made after 1 year. So if the first payment is not after 1 year, you bring the first payment to date, which means the last payment, now the first payment is in year 0, not in year 1. Today is year 0. After 1 year is year 1. So because the first payment is in year 0, it is now running year 0, year 1, year 2, until year 9. Those will be 10 years because we are starting with year 0. So we are starting with year 0 to year 9. So what is the cash flow? The cash flow is 2.5 million. That is the lease payment. Now, in an annuity, we don't use the normal present value formula. In an annuity, it is always 1 minus into bracket 1 divided by 1 plus R 1 minus 1 divided by 1 plus R raised to power n, everything again divided by R. But you know, in financial management, you are given the PV table and the annuity table. But in FR, you are not given the annuity table. So you must know the formula. In financial reporting, no annuity table. In managerial finance, I11, there is a present value and annuity table. So if you have not been given, you calculate. You have 1 minus into bracket 1 divided by 1.1 raised to power n is 9 years. Close the bracket. Everything divided by 0.1. R is 10%. 10% is same as 0.1. So it gives you, can we confirm that again? It was 10%, 9 years. Can I just do it step by step so that I confirm? Let me do it step by step. 1 minus, can somebody help me, the calculator to help me? 1 minus into bracket, or let me use this, 1 divided by 1 plus R raised to power n, everything divided by R. Everything starting from here until there. So can somebody help me in the chat using, so that will be, let me try repeating it again. 1 minus, I must be in a position to follow board mass. 1 minus into bracket 1 plus 0.1, that is 10%, raised to power 9. What do we get? We get everything divided by 0.1. If we divide everything by 0.1, so this divided by 0.1, it gives you, I have a feeling there is something which is not right. I should expect a figure less than that. Let me try doing manually in a calculator. I have a calculator with me. 1 divided by 1 minus into bracket, I'm using a calculator, 1 divided by 1.1. I want to see where I'm going wrong. Raised to power 9. Everything divided by 0.1. Everything divided by 0.1. Yes, I'm getting a different figure. Anybody who gets a different, I'm getting 5.759. Do you get that? Anybody who has calculated that to get 5.759? Yes, Divine, thank you. 5.79. Thank you, everyone who has calculated. Daniel, yeah, using Excel, it's challenging to me. So, or yes, you apply that formula. And if we apply that formula, you have said it's, type it again so that I write. It is 5.759. Thank you. So That is how we calculate the annuity. I've used a calculator and I found that. So that gives you 2.5 million times that, it gives you 14. So that is the entire present value. So that is the present value. So the present value is simply that. In an annuity, we get that. So that gives you the lease, sorry for taking a lot of time there, lease liability. Lease liability. But if that is confusing, I believe you are taught you can even use the present value table. You can use the present value to also calculate that. You can use the present value to calculate that. How do you use the present value? Maybe let me take you to managerial finance a bit. If that is challenging, you can use the present value like this. But I'll delete it after I've done it. You can use the present value like this. So you just list year 0. Sorry for that. Year 0, year 0, and then you have year 1, year 2, like that until year 9. So until year 9. If the first one is confusing, this is what you can do. Year 0, so when you count this, there are 10 years. Year 0, 1, 2, 3, until year 9. And the cash flows are 2.5. So whichever is easier for you, you can use that. So the cash flows are that. Now, if you decide to use these, you use the present value table. Is equals to 1 divided by 1.1 raised to power 1. Sorry, raised to power 0. That is year 0, it is 1. The second one is equals to 1 divided by 1.1 raised to power 2. This is a longer root, it gives you that. The third one is 1 divided by 1.1 raised to power 3. It gives you that. Sorry, this was raised to power 1, not 2. Raised to power 1. This was raised to power 2. This was raised to power. Actually, I mastered this offhand. It's just that I don't want to write what I've always mastered present value tables for 5%, 10%, and 20. But I'm just going the long way. Raised to power 1, power 2, power 3. Power 4 also 1 divided by 1.1 raised to power 4. And you continue like that until the last one. So you continue like that until the last one. So the next one will be power 5. The next one will be power 6. The next one will be power 7. The next one will be power 8. The last one will be power 9. Mugisha Gad, I think I've explained that. Why did we stop in year 1? Because we started, the first payment was made immediately. So the first payment was made in year 0. Year 0, you count 0, 1, 2, those are 10 years. The first period was in year 0. Mugisha, are we together? Gad, are we together? Because you were told the first payment being made on 1st January 2018. What is written there in bracket? Are we together? Okay, let's continue. So that, okay, so let's get the present value. We have this 2.5 million times the 1 million there. So we have that and we bring it there. Now, because I rounded off, there may be a small difference. But ideally, had I not rounded off, we could have got the same answer. So this is different because we rounded off, because of the rounding off. Remember, I used exactly 5.759, yet it was supposed to be 1 minus into bracket 1 divided by 1.1 raised to power 9, close the bracket, everything divided by 0.1. So it was giving us 5 point, a very long figure. So if we rounded off, we were supposed to get this same answer, should have been the same as that. But that you covered in managerial finance. So let me remove this. So those are the two options. But this second option is always longer, especially if you have 20 years, you have 15 years, you are not advised to use the second option. So this is the best option to use. This is the best option to use. So that is the lease liability. Number two, we need to find, I've taken a lot of time there, right to use the asset. So what is the right to use the asset? Right to use the asset. So in our right to use, let me copy and paste what we had here. We said right to use an asset includes, I'm just copy that so that you know that the formula remains the same. So right to use an asset includes, we said number one, lease liability. So what was our lease liability in this case? 14,397,000 lease liability. And then we look for direct costs. Let's continue reading. Annual lease payments were that ABC Limited incurred initial direct costs of 500,000. So direct costs are 500,000. ABC incurred initial direct costs of 500,000 in arranging these leases and received lease incentive of 250,000. So incentive was 250,000. Okay, next. So there was no removing costs. There was no removing costs. But there is the advance payment. The first payment being made on 1st January. So there was an advance payment of 2.5. The first lease was paid at the date of commencement. You add the amount of advance payment. You add the amount advance on commencement, the amount you paid on this 1st January 2018. So the amount you paid on 1st January 2018 was 2.5 million. So what is our total? 14 plus 500 plus removing, which is 0, plus 2.5 minus 250. So what do we have? The right to use an asset is that. The right to use an asset is that. Because we are in an online class and I don't want to take a lot of time in that. Now, how? Now the question is, this is under, remember, this is under initial recognition. So that I kill two birds with one stone, let me also look at subsequent recognition. How to account for subsequent recognition. Do you allow me to go to subsequent before I go back to the slides? Subsequent. Now in subsequent, okay, in subsequent recognition, again, now you need to know what lease liability. What lease liability? Allow me to go, and I'm seeing you have already affirmed yes. So allow what lease liability need to be charged in the first year? What liability needs to be charged in the first year? And what asset needs to be charged also in the first year? Now, this one in subsequent, let me write some notes here. I will go back to the slides and read. Subsequent recognition of this same question. Subsequent recognition. Now, in subsequent recognition, it depends on whether the rent payment, the lease payments rather, lease payments were in advance